I'm going to prove that you can stop wasting your money on the wrong investments. Because the market right now feels like a luxury mall built inside a casino. Everything is shiny.
Everything is the future.
And somehow every bad decision comes with a professional logo. The truth? The wrong investment is not always the one that crashes. Sometimes it's the one that quietly steals your compounding. The one with the sexy story. The one with the fancy fee.
The one that makes you feel smart while your money does absolutely nothing smart. That's the trap. People think investing is about finding winners.
A lot of the time, it's about avoiding expensive mistakes. And history has seen this movie before.
This is not a new scam.
It's a remake.
In the early 1970s, Wall Street had its own version of today's can't-miss trade.
They were called the Nifty 50. Big, dominant, beautiful companies. The stocks people thought you could buy at any price and hold forever. By the end of 1972, the average PE ratio of the Nifty 50 had climbed to about 41.9, while the broader S&P 500 was closer to 18.9. Great businesses, sure, but the price tags were completely unhinged. Then came the dot-com sequel. Same greed.
New haircut. In March 2000, the Nasdaq peaked near 5,048.
By October 2002, it had fallen roughly 77%.
That's not volatility.
That's the market taking a baseball bat to bad assumptions. And here's the lesson history keeps yelling at every new generation. A great company can still be a terrible investment if you buy it at a stupid price. That is where people get wrecked. They fall in love with the business. They forget to ask what they're paying for it. Now, let's meet the real villain. It's not just bad assets. It's bad math wearing good marketing. Sometimes the wrong investment is concentration risk. Sometimes it's fees. Sometimes it's buying the thing that already made somebody else rich and assuming you're still early. By mid-2025, the largest 10 companies in the S&P 500 represented almost 40% of the index. Almost 40%.
That is the highest level of concentration seen since the mid-1960s.
So when people say, "I'm diversified, bro, I own the index," sometimes what they really mean is, "I own a few giant companies wearing a trench coat." And then there's the fee problem. The fancy-sounding suit and tie robbery. The latest SPIVA scorecard says 79% of active large-cap U.S. equity funds underperformed the S&P 500 in 2025. They are paying extra to get worse results. In 2025, the average expense ratio for index equity mutual funds was 0.05%.
That sounds tiny. But fees are like termites. You do not notice them on day one.
Then one day the house is gone. If you invested $500 a month for 40 years, an 8% return grows to about $1.75 million.
At 7%, it's about $1.31 million.
That 1 percentage point gap costs you roughly $433,000. That is not a fee.
That is a lifestyle. That is decades of optionality vaporized because somebody promised to beat the market. So here's the twist. The wrong investment is not just the flashy one. It's the one with bad odds, hidden drag, and a story so smooth you stop asking hard questions. Now let's make this uncomfortable, because this is where people get defensive. You might be saying, "Okay, but what about AI?" Fair question. This is the gray area, because this is not exactly 1999. These companies are real. They have real earnings. They are growing fast. But that does not mean every AI investment is smart. That's the trap. A good theme can still become a bad investment when the crowd shows up. If everyone piles into the same idea, you don't have diversification. You have the same bet in different fonts.
So what does this mean for you right now?
It means the wrong investment is usually one of three things. The one you bought because it already went up. The one you don't understand.
Or the one quietly charging you fees.
That's where money disappears.
Not in explosions, but in slow leaks. So what do you actually do? Boring things. Low cost, diversified, understandable, and hard to mess up.
A system beats a prediction.
Consistency beats excitement.
For most people, that means 80 to 90% in simple, diversified investments, and a small portion for risk. If your risky bet works, great. If it fails, you survive. You don't need to be right. You just need to not be stupid at scale. Stop wasting money on the wrong investments, not just scams,
Overpriced ones.
fee-heavy ones, ego investments. The market will always tempt you with something shiny. Sometimes it's real, but price still matters. Fees still matter.
So don't try to look smart.
Become hard to fool.
Because the best investment decision rarely feels exciting today. It feels boring. And later, it looks brilliant.